Hello my friends, Jeff, Tax Rescue CPA. I'm often asked, can you make a deal with the IRS? And the answer is yes. The IRS has a program called Offer in Compromise, also known as OIC. And today, I'm going to show you exactly how it works. Let's dive right in. Now, before we get too deep into the OIC program, let's make sure this might work for you. So here are some basic requirements. First is you have to have all of your tax returns filed. This usually means the last 6 years. Secondly, if applicable, you need to have all of your estimated payments current. You need to have made your estimated payments in the right amount timely. Third, you can't be in bankruptcy. No bankruptcy if you're going to be applying for the OIC program. The fourth thing is you need to be in a financial position where you don't have the assets, you don't have the means to pay the tax debt in its entirety. The fifth requirement is that you don't have the income to pay off the tax debt using an installment agreement plan. So if you have an amount of income that would allow you, in the IRS's way of looking at things, to pay off the tax debt over time, they're not going to accept an offer from you. Okay? So think about those 5 things. Do you qualify? Do you kind of look like this guy right now? Okay, let's move forward. So what is the OIC program? This is basically where you come to the IRS and you say, look, I know I owe all of these taxes, interest, and penalties, but there's no way I'm going to be able to pay it. I will give you every dollar I have right now, and I'll give you even some of my income, my monthly income for the next year or two, and I'll give you all of that if you agree to take that and forgive the remaining tax debt. That's the deal part. I'll give you this if you do this. So this is really a situation where you have to not be able to pay the taxes. It's not just that you don't want to pay the taxes. For example, if you have the money in, either like a retirement account or even have equity in your house to pay the taxes, the IRS isn't going to accept an offer. So if that's your situation and you're just looking to not part ways with your cash or with your assets, this isn't the right program for you. The best way to explain this, or to really give the full picture of how this works, is to go through an example. So I've created an example taxpayer with some data that we're going to go through and look at so we can see just how OIC works. So for our example, our taxpayer is an unmarried individual with 2 dependent children under the age of 13. So I put together some financial details, and in this case, our taxpayer doesn't own a home, is currently renting, has an automobile that's got a market value of $18,062, has an auto loan on that car for $10,500. Now, personal property, and this is a category the IRS is kind of a catch-all. Everything else, pretty much all the stuff in your house, would be considered personal property. For our example, this taxpayer has furniture, jewelry, an ATV, and firearms, and the value of all these items combined is $8,000. As far as cash, there's a checking account that has an average low balance of $650, and there's $100 in cash sitting in the cookie jar at home. Retirement accounts. This taxpayer has an IRA from a former employer that was a part of a 401k plan that got rolled over, and it's valued at $2,500. Credit cards. Our example taxpayer has a balance in total of $32,000 in credit card debt, with minimum monthly payments totaling $436. Okay, now what about income? The income our taxpayer has is a net paycheck. So the monthly net paycheck, take-home pay, is $4,500. And there are no other sources of cash coming in or other income, no side hustles. If you basically look at the bank statement, the only deposits being made into that account are this monthly income paychecks. Okay, so now that we have our sample data, what are we going to do with these numbers? Well, what we want to figure out is how much do we have to offer the IRS? And the offer amount comes from two sources. One is the amount of assets you have that the IRS considers available to pay the tax debt. And two, it's the excess income, disposable income, or income after necessary allowable expenses as the IRS defines it. So let's jump in with the first one and the assets. We'll start with cash. So cash, we said that there was a total of $750, $650 in the checking account and $100 in the cookie jar at home. So here's the neat part. The IRS allows you to keep $1,000. They're not going to make you completely broke. So our example, the amount of cash that they have is less than $1,000. So in the cash category, the IRS will consider this taxpayer to have $0 available to pay the tax debt. Next, let's talk about the retirement account. So we said this taxpayer had an IRA account valued at $2,500. What the IRS is going to want to see with this is, first, you get to multiply it by 80%. You get to reduce the value of it to 80% because the IRS understands there's transaction costs, there may be tax consequences if you distribute from an IRA. So they reduce that by 80%. So you take the $2,500 times 80%, and that gives you $2,000. This $2,000 the IRS considers available to pay the tax debt. Next, we'll talk about the automobile. So you take the fair market value of the car, which we said is $18,062, and then you multiply that by 80% also. That gives you $14,450. Then you'll reduce that amount by the loan, which is $10,500. So that amount then comes to $3,950. Now, there's one other piece to this with cars. The IRS allows you an exemption amount, an amount you can reduce or take away or take off the table of $3,450 for one automobile per person. In this example, we have one person we're dealing with. So we take the $3,950 of equity that you have in the vehicle, we reduce that by the $3,050, and we end up with $500 in our calculation that is available for the IRS, as far as the IRS is concerned, to pay the tax debt. Okay, next, personal property. We said that the items that they had, the furniture, the jewelry, the guns, the ATV, was worth $8,000. Well, the IRS allows you to keep $11,390 worth of personal property. So that's more than the $8,000 that this taxpayer has. So again, like the cash, the IRS will consider there to be $0 available in personal property to pay the tax debt. So let's add these up. We had $0 from the cash, $2,000 from the IRA account, $500 from the automobile, and $0 from personal property. So putting these all together, we end up with a total of $2,500 in assets that the IRS considers available to pay the tax debt. Okay, so now let's move on to the second part of this, which is the income. Okay, this taxpayer's monthly net income is $4,500. Now the IRS allows reductions to this, right? Expenses. You have to have money to live on. The IRS understands that. And there's a couple different ways that you reduce these. You either can take actual or financial standards, but let's talk about the categories that these expenses fall into. First of all, we have housing and utilities. You can deduct for that. Then we have an auto loan payment. If you have one, the IRS will allow that within certain restrictions. Auto expenses, or you can deduct public transportation costs. Then we have health costs, including insurance, court-ordered payments. These are like alimony payments or child support that are court-ordered, or sometimes there may be a settlement that's court-ordered. You have to have the paperwork for that. The other category is daycare, so that the parents can work, life insurance premiums, and the amount you pay for federal and state income taxes. So those are categories that the IRS allows you to reduce your income by in coming up with the amount that's available to pay tax debt. So in our example, the expenses in those groups total $4,150. So we take the $4,500 worth of income, we reduce it by $4,150, and that leaves us $350 per month that the IRS considers available to pay tax debt. Now, here's the tricky part. What do we do with this $350? Well, it depends. We're either going to multiply it by 12 or by 24, depending on how long you agree to or offer the IRS to pay off the offer amount. Okay, let's back up a second. So the offer amount you come up with, when you submit your application, you're going to tell the IRS, I'm going to pay this amount off in less than 5 months, or I need up to 24 months to pay this amount to you, to give you my offer amount, okay? Here's what those are called. There's two different offers essentially. When you submit the application, you're going to choose whether you're going to offer a lump sum offer or a periodic payment offer. So let's talk about lump sum. This one has a shorter payoff. Lump sum is when you offer to pay the IRS within 5 months of the acceptance, okay? So you offer them 5 payments within 5 months of their acceptance of your offer. With this type of offer, you're going to multiply the monthly income amount, the net disposable income, you're going to multiply it by 12. So we're going to take our $350 amount, multiply it by 12, and come up with $4,200. So this is the income side. So remember, we have two pieces. We have the asset side and the income side. So now for our lump sum offer, we're going to add those two together to get the total offer. We're going to add together the $2,500 in assets added to the $4,200 worth of the monthly income times 12, and we get a total offer amount of $6,700. That's how it would work for a lump sum. The periodic payment offers similar, you just change your monthly income multiplier from 12 to 24. And in a periodic payment offer, what you're saying is that I am offering you this money, IRS, and I will pay it off. You agree to pay it off within 24 months. There's a little difference in the clock. On the lump sum offer, this is a little side note. On the lump sum offer, the clock starts when the IRS accepts your offer. Then you have 5 months to pay. In the periodic payment, the clock starts when you submit your offer. You start making payments while it's being considered and reviewed. Okay, so let's do the math on this one. So with the periodic payment, we're going to multiply our monthly disposable income amount by 24. 350 times 24 gives us $8,400. So now we combine that with the asset amount, $2,500 for assets, $8,400 for income, and we get an offer amount of $10,900 if we're going to submit a periodic payment offer. That's how we calculate the two different options and come up with the amount we're going to offer the IRS. Now let's talk about the application process. Now that we know and have calculated what our offer amount is, or make sure it makes sense given how much we owe. If you owe $3,000, it's not going to make sense to offer $6,700. So let's assume that we've got a tax debt that these offer amounts make sense to try to work out a deal with. Let's talk about the things you've got to submit with your offer. First of all, if you don't qualify for a low income certification, you'll need to send in an application fee. Next, if you choose the lump sum offer, you're going to need to include a 20% down payment with your application. And this is non-refundable. If you choose the periodic payment offer, then you'll need to agree to payments, which again begin immediately, unless you qualify for the low income certification. And again, any payments under the periodic payment offer are also non-refundable. This is if the IRS rejects your offer, they're going to keep any payments you've sent, no refunds. And then the other thing is, make sure you send every financial support document, everything that supports the numbers you're giving the IRS. Don't skimp on this one and hope that the IRS doesn't ask for it. They will ask for it, and it will only serve to delay the application process. So get all that submitted. What are the actual documents you need to send in? you need to send in Form 656. That's the offer and compromise form. Then you need to send in either Form 433A OIC and or 433B OIC. These are financial disclosure forms. So these are the ones that ask for all the financial details of your situation. And then you also, again, you need to send in the initial payment amount depending on the option you choose, unless you meet the low income certification. Then your application is going to go through 2 phases of a review process. Let's jump into those. The first phase of review is sort of a high-level review, and the IRS is just looking to see if you meet the basic criteria of having filed all your tax returns. Are your tax returns current? Are you current on any estimated payments that you're required to make? And are you in bankruptcy? Because that will kick you out. So those phases, they check relatively quickly to see that you meet those criteria. And if you don't, you'll relatively quickly receive a letter stating that your application is not going to move forward and you need to try to do something else. The second level review, that's the deep dive look. So this is when the IRS assigns an employee to your application, and it's that employee's job to look deeply into your financial situation, confirm all those details that you have provided through the Form 433, and look and see if there's anything else that maybe you left off. That's their job. And they're going to communicate with you, probably ask for more confirmation, ask if anything's changed, and just do basic digging around anything that comes up in their search. And it's at the end of this second review that you'll receive the official rejection or acceptance. Now, let me go back up to the first level. Keep in mind at the first level, if you get rejected, the IRS has never really processed your application. They look at it and they say it just doesn't meet any criteria and you don't have any appeal rights. But if you get rejected in this at the final level after the second review, then you have appeal rights. When you get rejected, they will tell you why, and you will probably have already had a discussion about the reason with the IRS employee. They'll discuss it with you because they're trying to get these things processed, and sometimes having a discussion makes this go a lot smoother. But you'll get notification of why it was rejected, and you'll be given the option to appeal. Don't ignore this option. It may be a situation that they rejected your application from not understanding something, and by providing clarification or explaining the situation to somebody else may just get your offer accepted. And it's a lot easier to appeal and get accepted than it is to start over again. So don't ignore the appeal option if your offer is rejected. Okay? If it's accepted, celebrate. At this point, you've basically been given a winning lottery ticket, and you've entered a club of a very small group of Americans who have had a deal made and successfully had their offer and compromise processed. So this is the time now where you want to review everything and make sure that your offer doesn't later get revoked, because that's the other thing IRS can do is if after your offer is accepted, if you don't meet the requirements of basically staying in line, towing the line, doing what's right, it will get revoked. Your acceptance will get revoked. So what do you have to do? Well, you need to make sure you make your offer payments on time. So that offer amount, you need to make sure that gets paid on time. You need to file the next 5 years of tax returns on time before April 15th. You need to make sure there's no tax balance due at April 15th for those 5 years. So for the next 5 years, you have to pay your taxes on time, and generally just be a good taxpayer. Okay, now at this point, you're starting to realize the benefits of this program. Okay, well, first of all, you made a great deal, and you saved thousands of dollars most likely on taxes and interest and penalties you would have had to pay otherwise. No more collection headaches. Okay, all of those are going to go away. The levies. The liens are going to be released. That's the big thing for a lot of people, is the liens are going to be released. And then lastly, the huge benefit is just being able to sleep at night again. The relief that comes from this program is really, it can't be understated. And this is one of the things that when you deal with this at this level where we're just talking back and forth and talking about it, it's really hard to understand and feel the benefits of this because of the emotional and the way that just works through every aspect of your life. And getting this resolved through an offer and compromise program is really a wonderful feeling. Okay, some pro tips. So we've kind of gone through the basics of it. Let me give you some pro tips on how to make this thing work for you and avoid some pitfalls that a lot of people fall into. The IRS has a tool online called the OIC Pre-Qualifier. Now, this is a fairly in-depth tool they have that has a lot of questions, but I highly recommend you go online and go through it. In fact, on the application, there's even a box that says, did you use our tool? Have you checked this out that you qualify using the pre-qualifier tool? So go online, go through that tool, and see if this program might be right for you. Now, my second tip is to pull your transcripts. Pull your transcripts. Remember how I said you have to have your tax return filings current? You need to be in compliance on filing. Well, sometimes you can forget or lose track. Pull your transcripts and review them to make sure all of your returns have been filed and you are in compliance. I've got a great video here on how you can do this online very quickly. Pull your information and go through it. The third tip is to use the IRS financial standards. There are a lot of categories that you can use a fixed amount based on, these criteria are based on where you live, based on which state or which city. They're based on how many are in your family. Some of these standards go up if you have more members in your family. The areas that you can use the standards for that they have allowable expenses are food, clothing, health costs, housing, utilities, transportation. Okay? Food, clothing, health costs, housing, utilities, and transportation. Be sure to use those standards. They could really affect your net income number. Remember that 350 in our example? Sometimes using those standards can really drop that number down and give you more allowable expenses. Okay, tip number 4 is don't send original support documentation to the IRS. So when you're going to send in your bank statements and these kind of documents, send in copies. Don't send in the originals. But please do keep a copy of your entire application. So before you mail it in, take a copy of everything so you know exactly what you sent and you know what the IRS is looking at and you can remember what you told them, basically, because you're probably not going to hear from them about the details of this application for 4, 5, 6 months. And sometimes you lose track of what you said. So keep a copy of that so you know what you're talking about. And my 5th pro tip is to stay current. Nothing will derail an OIC application quicker than not filing a tax return. So if you're submitting this and there's taxes due soon, not filing that return is going to kick your application out. They're going to say, no, you didn't file your last year's tax return that was due last month. You didn't file it timely. We're not going to continue this application completely. Kick it out. You got to start over and you lose any money you sent in. So that's a big overview of the OIC program. I hope this was helpful for you just to kind of figure out if this is something that could work for you or not. If you have questions, it's a fairly detailed and all-encompassing application. If you have any questions, throw them in the comment box below and I'll do my best to answer them. Thanks for watching. Take care.